what an exciting panel we have. Common sense from uncommon investors. And I remember many, many years ago, more than 40 years ago, I went to visit one of the largest institutional investors, and I was trying to explain to him that the attractiveness of Lowe's 6 7/8, this was a company which was founded and run by Larry Tisch, and how much value they had. And they were trading below 50 cents on the dollar. And I was talking to the chief investment officer, and he told me, wait a minute, isn't Lowe's a conglomerate? I said, yes, they have 3 or 4 different businesses. He said, well, conglomerates are in financial trouble and they're all going to go bankrupt. And I figured at that time he had done so much detailed information and analysis that I would just try to buy him if he owned them rather than try to sell them to him. And I think we are quite often surprised how little research people do and how divorced they are, and sometimes from the real world. And the best investors take a look at the world on a macro basis and then try to figure out, looking on a micro basis, where best to deploy it. And we have with us today 5 of those who have been very successful over a long period of time, who in many ways represent uncommon investors using common sense. And so I'd like to start with you, Sarah, if we could. Tell us a little bit about your firm, and I think tell us a little bit how you differentiate your approach.
Well, Causeway Capital began in 2001, and our genesis is that we really wanted to keep our team together. We were the prior firm that was going to be sold. And the asset management business is one of stability. And what we believe in as an enterprise is that there's plenty of undervaluation out there in the global equity markets, and it's up to us to take advantage of it. But what makes us somewhat unique is that we're combining fundamental analysis, which is understanding companies' financial statements, interviewing managements, with quantitative computer-driven models to arrive at an optimal portfolio. We do this both for clients who want global portfolios or emerging markets, so we cover every corner of the world. And our job is to identify mispricings where investors have failed to use price discipline. Passive investing often leads to some of that mispricing.
So, Sarah, if many of our members of our global capital markets group, whether they be sovereign wealth funds, pensions, endowments, corporations, family offices, insurance companies today, have allocated increasing amounts of their assets to ETFs or other forms, or just buying indices with the idea that they're not able to outperform indices. Obviously, your firm has a much different philosophy on that. Maybe you could just discuss that for a moment with us.
Well, the $40 billion we manage, it's all active. And presently, just to give you an example, right now we see this tremendous bifurcation where defensive equities, those companies and businesses that are economically defensive, not affected by the economic cycle, they're often in consumer staples or utilities, trade at extraordinarily high valuations relative to the cyclicals in the same markets. The cyclical companies aren't broken, just nobody happens to want them right now. So for a longer time horizon investor, as we are at Causeway looking out 3 years, we have no interest in the defensives. And yet the more risk-averse investors become, the more they get uncomfortable with the political environment. And you could name the geography and there's a problem. They're very interested in, they think, avoiding it by, for example, one of the greatest areas of passive investing of late has been in smart beta strategies through ETFs, exchange-traded funds. And investors have been piling into the higher dividend-yielding strategies. Well, that's created this very peculiar situation where lower-yielding stocks, where there might be an opportunity to see dividend increases, have been totally ignored. So that's what gets us excited. There's very definitely an opportunity at present in cyclical stocks. And yes, there still is an economic cycle.
Thank you. Mark, your firm, since its founding, has tried to take advantage of where common sense has left reality. Talk to us a little about your firm.
I'm one of the founders of Creston Capital. Myself and our two co-founders, Jean-Marc Chappis and Bob Beyer, worked for Mike at Drexel in the 1980s. And for 25 years now, we've employed a lot of the precepts and investment strategies that Mike taught us as the high yield market was in formation. And I think one of the reasons we've succeeded over these 25 years is we've stayed very steady in our process and our investment focus, irrespective of where the markets were. So at the points of greatest volatility or maybe arguably the greatest fear, we found those are the best times to invest. And likewise, one of the things we learned at Drexel and working with Mike was how to look at complex situations and spend the time to analyze them and thereby gain an advantage, because most investors don't either have the expertise or want to do the work. So actually the very first thing I worked on for Mike, and I wasn't going to mention this, but I'd worked on a very complex holding company called Great American Management that was run by Sam Zell and Bob Lurie. And I had this enormous, we didn't have kind of software we have today, so I had this enormous spreadsheet on my desk. It was probably 4 feet by 4 feet, diagramming this credit. And Mike called me to come over and talk to him about it. And so at that point, the senior person on the deal was Kenny Moelis. So I ran over to Kenny's office and said, Mike wants to have us talk to him about GAMI. Only problem was Kenny wasn't there, he was traveling. So I had to go over to the trading desk on my own. Mike never looked up. For like 3 minutes, he asked me questions. I realized I completely missed the forest for the trees. But somehow I must have gained enough confidence in what I was, the analytics, that I continue to work directly for Mike. And we find it at our firm today, these complex situations at points that there's market volatility. Right now, we're working on an investment with a very large sponsor that requires a $500 million mezzanine commitment. And it's got a complex intercreditor situation. Most firms want nothing to do with it. And at the point we had to make the commitment was a point earlier in the first quarter when the markets were a little sideways. We're able to work through that, keep our credit discipline, bring in some of our LPs. Some of our larger LPs get to invest side by side with us. So on a $500 million investment, we may only take 100 or 150 million in our fund and share it with our investors. The patience to work through that, which we've been working on for 9 months, is, I think one of the reasons that we've succeeded all these years, as well as having I should add, a talented group of professionals around us. We've got upwards of 80 investment professionals at Crescent, all of whom really deserve the credit for working on credit. And I think keeping that focus, keeping our processes in place, and looking for advantages in a market that always provides opportunity. The capital markets always provide opportunities. You just need to know where to find them, is the reason that we've, I think, we're still having some investment success, and our firm has grown to over $20 billion in management today.
I think you've had more than some, Mark, as an LP. I'm happy to see that. You showed me this quote about keep calm, sell everything. It seems
I gave a speech earlier in January in the midst of all this. Now in hindsight, it's always easy to look at these things in hindsight. But I spoke at an Ernst & Young conference in January when there was very high nervousness, and a lot of questions from the audience were, are we going into another fiscal crisis? Is it 2008 all over again? And the backdrop against that was a quote like this. Well, that's exactly the kind of environment we like to invest in, because we can take our time-honored principles, our time-honored diligence, and importantly, work with a lot of our better relationships. So at the point people are looking to find the exits and sell anything that's not nailed down, we like to have a bid. And I think what we'll see over the next couple of years are some of our best investments will be those investments that we made in the first quarter of 2016.
You know, it's interesting, when we talk about risk, which is a subject we'll get into on this panel, often the greatest risk is when you perceive there's no risk. So if you put back up that quote of sell everything, it's so interesting because it's quite possible some of these high quality bonds hold the largest risk. You're not receiving any premium for owning them, and when you have someone that wants to sell everything. One of these areas that had the greatest risk was sovereign debt. And over the last 1,000 years or more, probably 2,000 years, the worst performance or the highest defaults have occurred in sovereign risk. Yet until the 1980s, they all traded at 100 cents in the dollar. You weren't required to put up reserves for it. And actually, the individual who wrote the book, Risk and Other Four-Letter Words, Walter Wriston, risked the future of Citibank by many of these investments in sovereign countries at the time. And the head of the Federal Reserve in the late 1970s pointed out that no one ever lost money in sovereign debt, and countries don't go in default. Well, it had nothing to do with history, but this is one of the things you see in financial markets. You can say almost anything, and very few people disagree with you. So, Kyle, you have questioned conventional wisdom constantly with great success. Talk to us a little bit about your firm.
I think from the formation of Heyman Capital back in early 2006, I have both the blessing and the curse of being able to spot or attempting to spot anomalous situations around the globe. Fortunately enough, we were working on housing and mortgage finance in early 2006. And then we followed the bad private assets to the public balance sheets. And I had, again, not ever done any work on public balance sheets. And we started doing public balance sheet work in mid-2008. And I realized after talking with the entire sell side that no one had a public balance sheet model for, call it on-balance sheet sovereign obligations, plus the size of host countries' banking systems. I thought that was fascinating that no one had put that spreadsheet together, and I know it exists today, but in mid-2008 it didn't exist. And everything I read then said ex-Japan on it. And I was trying to figure out why everyone was going to ex-Japan out of every study that was published. So after we came to the conclusion that you were going to see some European countries fall, we started looking into Japan and followed again this idea of population demographics and a model of a country that was going to implode under the weight of its own debt unless they engaged in a massive QQE program. And so we've launched a series of funds that were really all of them structural anomalies, whether it was US subprime funds early, whether it was subprime funds long on the back of that, whether it was our Japan funds, and now focused on China. All of these scenarios, kind of bringing back to your mission on this panel, is common sense. If you took the time to do the work on these situations, it was all pretty. You just use common sense to figure out that these situations can't persist, and then you have to look for triggers. And we'll get into it a little bit later. But what's going on in China? I know there are a lot of capital allocators out there allocating to China. In fact, I sit on the board of a big endowment in the U.S., and I think it's done without a lot of fundamental understanding of exactly how these systems work. It's done with this belief in the omnipotence of the sovereign, and I think those beliefs, although they should have been shattered in the last 10 years, for some reason continue to be reinforced today. And again, it's a blessing and a curse because 98% of the time I'm swimming upstream. That 2% of the time will get you, though.
Well, that is true. Mitch, tell us a little bit about your firm.
Well, Josh Friedman and I are alums from Drexel, like Mark. We set up Canyon in February 1990. We run over $20 billion, which seems to be the number on this panel. And I think the common sense notion that informs what we do across the various platforms is that the world's complex. I think we all can agree that it's not an equilibrium world. Things tend to overshoot, collapse, oscillate. We know this particularly since 2008 in spades. And interestingly enough, as an alternative asset manager, it is a good strategy over time to invest in complex instruments. So if the world's complex, the world tends to create these complex instruments, which in many cases fall in the gaps and cracks of the financial system. And you talked about the macro environment and how it informs all those different micro situations in which we invest, whether it's corporate balance sheets, securitizations. The macro situation, particularly since 2008, has been one where the financial system has become increasingly fragile. I think that's another common sense notion. And this is the way you can think about it. Three major balance sheets at the macro level which inform what we do in the non-bank system as a provider of capital or provider of liquidity to fill these gaps and cracks. So you have central banks, which we know have been accommodative. They've expanded their balance sheet. They provide an insurance policy to the financial system, keep it from seizing like it did in 2008. So who's paying for that insurance policy? I think, again, it's common sense to observe that it's the money center banks. They're paying for it in terms of regulation, litigation, and you see it in the way they're having to restrict the use of their balance sheet, downsizing. The extreme case of this is Europe. The GDP of the balance sheet capacity of European banks to GDP in Europe is totally outside 300%. And so they're going to shrink. Now, when you think about central banks providing an insurance policy against seizing, money center banks having capacity being taken out for providing financing and making markets, and then the so-called shadow banks or the non-bank banks, including alternative asset managers like ourselves, that delta change in capacity is going to be filled ultimately by the non-bank system. But for the time being, when you take out so much balance sheet from money center banks, Deutsche Bank, et cetera, the shadow banking system can't fill it totally. So that means both a blessing and a burden. The blessing is, as one president of a World Bank told me a couple of years ago, we only make money if you make money. We're not in competition with you. We're in facilitation. We're supporting you because we need your balance sheet. So we will show you opportunities that are not in the high yield index, that are off market. We will need you to provide financing to some of our clients because we are not allowed to do it. And so that's the blessing. The burden is that when the money center banks take their inventories down to 10% of what they used to be, or sometimes go negative, what happens? Market liquidity evaporates in a flash. You get huge gaps in pricing, and you're subject to mark-to-market. So to recap, the world's complex. I think structurally, there's a lot of endogenous risk. It's different from exogenous risk. It's built into the structure of the system. If you don't have the common sense to understand that, you're going to be caught by the ebb and flow of market liquidity, and you won't be able to take advantage of these opportunities. That's why structural alpha or staying power is important. Last thing I'll say about this, and the opportunities it creates in trying to understand over-leveraged companies and securitizations, is that when one of the best ways to buffer the ebb and flow or the oscillation of market liquidity, which is going to only increase, is to find securities that are, in a common sense way, tied to sources of liquidity and wealth outside the capital markets. So in other words, if the world is marked by endogenous risk, why don't you find securities that are marked by endogenous liquidity. Simply stated, you get interest, you get amortization of principal, there's a maturity, you have covenants that give you a seat at the table if they're violated, you have collateral, you can buy securities at a low dollar to par, which is another source of protection. All the things that any distressed or special situation investor knows, but are an increasing part of the financial landscape today and will be here for the next 5, 10 years.
Thanks, Mitch. Every June, I travel around the United States raising money for cancer research, going to ball games. And a number of years ago, I saw this quote from Frederick Wilcox that I thought was apropos to this panel. And it was, progress always involves risk. You can't steal second base and keep your foot on first. And I think a lot of times in that quote that Mark talked about earlier, the idea that you're going to step aside, just stepping aside is a risk. And one of the most successful young people in the world, I think, said it also, Mark Zuckerberg. The only strategy that is guaranteed to fail is not taking risk. And one of the real challenges that we have is so many investors, once again, perceive they're not taking risk when they've taken great risk. And I know that, Michael, you really look forward to volatility, not necessarily in your life, but in your business. And you view volatility that Mitch spoke about as a friend, not an enemy. Tell us a little bit about that.
Yeah, Michael, thank you. Clearly, it is a huge opportunity in the world which we live in. We manage customer money, $12 billion. Our balance sheet is significantly larger, so we actually trade a lot more than that. We focus on credit, is where we start from, but that said, we trade up and down the capital structure. But again, what the key on all this stuff is to do the fundamental work. Now, let me talk about this in a slightly different way. We have a problem of knowledge. Once you get to knowledge, and frankly, it's cheaper today to get to knowledge because of the amount of IT out there, the amount of systems out there. You've got the Bloombergs, you've got the Reuters, you've got all these other things out there. You can get to knowledge pretty cheaply. What you can't get to cheaply is insight, because that requires context, that requires imagination, and requires the ability to understand where you are. Now, the interesting thing about that is, for us, is once we've done the deep dive, and let's be clear, we're not going to be right on every point. We have a view, but every decision is never 100% right. It's always going to be a probability game. And the reality is the volatility can push you into a different part of that probability spectrum. And if you've done the work, we can then relate to that. We can change our view very effectively, very quickly. And again, for us, the volatility is what allows us to have an exciting return for our clients.
Thank you, Mike. Kyle, let's get down to maybe the micro more specific. You've been very focused on China. Why don't you give us a view as to your thinking and the work that you've done in China, similar to the work you had done on mortgages at another point in time, and maybe we can pull up a couple slides and take a look at it.
Sure. Let's just talk about a couple of common, what I believe to be misperceptions, misconceptions about their market. I'd love to see from the crowd, how many people in the crowd believe in 2015 that China had a balance of trade surplus in cash terms? Yeah. I think that's the common perception, is they had a $500 billion surplus. So when you look at it, that's pretty much on a GAAP basis. If we look at slide 14, what's important is when you look at the bank settlement data, they had a balance of trade surplus of roughly 500 million as reported by the Chinese government. However, when you look at payments on the banks and claims on foreign financial institutions, you see that they actually had a cash deficit of a balance of trade of 125 billion. And if you look at the net errors and emissions account from the Chinese government, it happened to be 630 billion. It foots perfectly. And yet, the sell side seems to believe that their balance of trade is going to keep them in the right spot from perspective of capital outflows, capital inflows. Again, this is just one really easy example of something that is quoted with dogmatism in the marketplace by the sell side, where it's basically gap versus cash accounting. And again, this moves all the way into the construct of the Chinese banking system, which is something that we've spent a lot of time on. I'm just going to explain real quickly what it looks like. Today, that system on balance sheet is about $30 trillion. Their GDP is about 11.5. And when you look at off balance sheet, in 2014, there was an accounting convention that required the Chinese banks in their 2015 annual statements to show non-consolidated assets, i.e. wealth management products, as a footnote. That number's $4.5 trillion. So 30 plus 4.5, and the 30 includes the PBOC's assets, so you might have to take a little bit out of there. Point being is they have a banking system at $34.5 trillion on GDP of $11.5 trillion. Their system is more than twice as large as ours was going into the financial crisis. And if you'll pull up slide 16, I'm going to talk about something that's really worrisome to us. And if you remember those things that caused all of the trouble in the US banking system early in our crisis, they were those asset liability mismatches between long-term assets and short-term liabilities, and asset-backed commercial paper facilities, structured investment vehicles. When the losses in the mortgage market started to funnel their way into levered asset liability mismatches, things happened very quickly. Losses showed up that no one predicted, and yet, as a percentage of assets in the US banking system, those mismatched items were only 2.5% of our system at the end of 2006. And if you look at the most, let's say some of the worst players were Citibank and ABN AMRO at 6, 7, and 5, 6. In China today, remember their system is twice as large as ours was going into our crisis. Their asset liability mismatches today are more than 9% of their system and growing at almost 60% a year. And my point here is what they're doing is taking the corporate bond market and the government bond market, and they're offering almost enhanced money market products over there. You get 1.5% as a deposit return, or the bank will sell you what's called a wealth management product at 4.5% or more. 4.5% is the average. And that's done through 4 to 10 times interbank leverage and leveraging these things that are in their corporate bonds that are now showing defaults. So if you go to page 15, slide 15, what you see is defaults starting to move. So in China, we see 1 default in 2014, 9 in 2015, and 16 through mid-April of 2016. Why is that relevant? I assume that everyone that reads the financial press around the world assumes that if a state-owned SOE, state-owned enterprise, goes down in China, that the government's going to pay for everything. Well, so far in 2016, of the 16 that have defaulted, 8 are SOEs, and of those, 2 are federally owned SOEs. 1 is in the overcapacity industry, and 1 is down the center of the fairway of the One Belt, One Road program, and none of them have been resolved. So when you have a banking system as levered as it is, as recklessly grown as it's been, it's grown 1,100% in 10 years with no loss cycle, common sense would tell you that they're going to have a loss cycle. The problem is when they start to have that loss cycle, you have a system that's so highly levered that $4.5 trillion of wealth management products have to roll. The liability structure of that, 90% of that rolls in less than a year. More than 50% of it rolls every 3 months. So you have almost $350 billion rolling every month based upon the confidence of Chinese retail investors in the levered wrapped vehicles that the banks have saddled them with. So when you think about how precarious that system is, if you took the time to look at it, you wouldn't be allocating money to China right now because you're going to have, in my opinion, you're going to have a restructuring of their system. It's not the end of the world for China. But if you're allocating money to Southeast Asia, you better be thinking, number one, can you handle a 30 or 40 cent write-down on your Chinese investments? My answer is no, you shouldn't. And number two, How do you think about the second and third order effects to your portfolio of me being right about their banking system?
So thank you, Carmen. I think one of the keys we should underline is the tremendous difference in the United States versus other countries around the world, and that the Asian crisis in '98 started in Thailand. 5 banks essentially provided all the capital. When they had a problem, everyone had a problem. And the U.S. today, the banking system shrunk in the '80s. Bank of America shrunk by 50% adjusted by inflation, yet the economy went in that we were essentially financed by private and public markets rather than our banking system. And when the 3 largest banks in France are as large as the 3 largest banks in the U.S., with 1/7 of the GDP, we obviously have a different financial system today. Mark, I was interested on your slide on what's changed, slide 6. Maybe you can take us through, as you look at this, what is your investment process and what are you thinking about at Creston?
Well, we try to look. We try to sometimes look at things without getting caught into the intra-period volatility. And here now we're looking over 15 years to see what's changed. And it's pretty obvious what's changed is the Fed balance sheet has gotten a lot larger as they've helped support a difficult economy. Although if you look at what's happened in Europe and how much longer it's taken for Europe to get out of their doldrums, so our GDP fiscal crisis in 2008, by 2012, we were showing growth back to beyond prior GDP levels in the United States. Europe finally hit that parity now 8 years later. So, there is a good news story to the Fed, ballooning its balance sheet, which is that you can see an improving stock market, you can see improving yields on our bonds, notwithstanding that there's a very low, continued low interest rate environment. And Mike, at one of your conferences several years ago, I had talked about a U-shaped or recovery, a much slower recovery in the U.S., which we're having. If you go back a slide to slide 5, we have, Kyle mentioned in some detail all the geopolitical and economic risks in China. That's one of 20 things that's worrying us at Creston. Since we focus on credit, we tend to just be nervous Nellies a little bit, notwithstanding our confidence in our process to invest in difficult times. So as you can see here, we're worried about everything from mosquitoes and maybe a pandemic with with some of the illnesses that are mosquito-borne, to challenges in the regulatory environment. So a lot of challenges in the regulatory environment around the world, which has created opportunities, which Mitch has described today. Banks no longer want to lend money, or frankly, they do want to lend money, they just can't because of Dodd-Frank regulations and Basel III regulations. That creates opportunities for us. I've got a slide, I've got a quote from Wayne Gretzky, I think it's slide 12. And Wayne has been an active participant in this conference over many years. Skate to where the puck is going, not to where it is. So, at our firm, I think we try to know what we don't know. So you hear the detail from Kyle on China. That is way beyond anybody's understanding in our firm. So we're going to leave China to Kyle. Frankly, we were fortunate. We recognized years ago that energy really wasn't our expertise. It was a very easy carry trade for a lot of Wall Street firms. We felt you needed to have engineering expertise and geological expertise, and you had to really be on the ground in the oil patch. So, we don't have any energy investments in our private investments in mezzanine or in direct lending, and that certainly served us well last year. But what we did move to, and as they did at Canyon, we moved into Europe because we saw the regulations tightening up in the banks there and set up a direct lending business there. And we moved to set up a direct lending business in the United States as banks just don't make loans anymore. By the way, I always felt this moniker of shadow banking was really pejorative, a lot like we used to talk about.
It's meant to be.
What's that?
It's meant to be.
Right, it's meant, right? It's like it's
Well,
shadowy.
we know as we went from high yield to junk bonds, I think, but I think one of the things Mark has said here that's so important, when you see a headline that's negative, or when you see regulation is coming, this presents opportunity. Whether you have the expertise to take advantage of that opportunity, as say Mark or Michael or Mitch does, as they increase the regulation on financial institutions, or not. And I think the other thing Kyle has pointed out here is one of the best ways to make money is not to lose it. And as Mark pointed out, if you don't have expertise in a particular sector or knowledge, invest with someone else who does rather than try to diversify. Sarah, I'd like to go to you. And let's pull up slide 29, and maybe you could spend a few minutes talking about it.
I mentioned this earlier. Now you can see it illustrated in the blue line. And this gets to this idea of, well, I could just go ahead and hide in certain stocks. They're in consumer staples, say food, beverage, and tobacco would be an example. But they traded very high valuation premiums, these defensive stocks, to the cyclicals. And why am I so excited about cyclical stocks? I mean, you listen to this panel, it sounds terrifying. I think we can contain China. There's probably a zombie bank future there, not too dissimilar to what happened in Japan, which means very slow growth, maybe very little real growth. Let's just move on to this next one, slide 30, and I wanted to show you what's happening in the world of value, which is something we specialize in, both fundamentally and quantitatively. It looks awful. It just recently had a little bit of an upturn, but what hasn't moved, if we go to 31, I could get through these in record time, it's financials. And so we've all sort of touched on some of the concerns about financial institutions. Banks and insurance companies globally have been laggards, and the area of most toxicity is Europe and banks. Nobody wants anything to do with them. You saw Brexit on one of the slides. If the British decide come June to vote to leave the EU, this potentially could be problematic. I happen to think that we'll all get worked out in the wash because of codependency, Europe with the UK. But dividend yield has been the only game in town. Everyone wants yield. But curiously, let's go to 32, and that exhausts my slides. This is a way for us as value managers. We do this quantitatively, a team of 7 dedicated quants, a couple of PhDs. When do value stocks perform well? Any of you who are invested in value probably have, it's agonizing. You go through a couple of years of underperformance, and then finally it cycles back up. Well, the turning point we've figured out is when there's a great disparity in valuation within sector. And the biggest disparity we're seeing now is in financials, which I've put this red box on, and where you're not seeing any disparity, meaning investors are completely indiscriminate in how they value the stocks, is within consumer staples, with consumer discretionary also looking a little closely valued. So lots of passive money has moved into the right, the active money is terrified of the left, but on a price to earnings basis or price to book value, you'll find relative to benchmark that banks trade at historic lows, yet they have twice the level of capital. So as far as we're concerned, maybe these banks in Switzerland and France represented a large percentage of GDP. They've always done so, at least in modern times. But what's different now is they don't need capital. It's the business model and revenues that need to be improved. And good management, if you could find them, that's why you pay active managers to go find those individuals who can improve the operations of an enterprise. Meanwhile, they'll start returning more capital to you, and they will be the dividend stocks of tomorrow.
Thank you, and I think just to paraphrase Sarah's point here, it's a lot better to buy the dividend stocks of tomorrow maybe than the dividend stocks of today. Get a lot higher rate of return on your money. Let's go to slide 22, Michael. I'd like you to spend a minute talking to that slide. And we talk about a lot of things, and the folklore really is from Albert Einstein when asked what was the most powerful force the world had ever created, his answer was compounding.
Did he really say that?
Well, there's a little question on that. It's in the folklore, and you can read it as a quote by him, Mitch. But since you, last time I checked, you're on the trustee of Princeton, supposedly he said it when he was at Princeton.
Okay.
That's why Mitch is questioning. Michael, let's talk about
Yeah,
it.
well, look, I mean, the biggest challenge we've all got is to make a return. And remember, a lot of the endowments here need to pull out the best part of 5% per annum. And the reality is, people don't seem to realize 5% compounding is a really ferocious number. I mean, if you do it since 1 AD, and you had $1, and I mean, I'm sure there was more than $1 around in 1 AD, if you compounded it, we have 2.4 times 10 to the 42, which is a massive number. I mean, and the reality is the stars in the universe is meant to be 1 times 10 to the 24. I mean, that's a funny old number anyway. But the reality is that it's a very, very difficult road that everybody's hoeing to try to keep that going. And there's got to be a realism. There's got to be an element of the common sense behind what we're trying to do.
You want to touch on a couple other points? So I think, Michael, your objective is to try to figure out how to compound at high rates.
Exactly so. And I mean, the point is, can we do it with everything? And it is really quite an issue. One of the things that I've looked at over a period of time is what has allowed us to grow what has allowed our economy to grow over the last 30 or so years. And remember, and we might go to slide 24 if we may, what's allowed that to grow? If you remember, in that period of time, we've had a situation where growth was pretty modest. Rates were very high, but what has changed in that period of time? And for me, it's quite interesting. What's changed in that period of time is the derivative market. The OTC derivative market has grown at one stage exponentially, and now since the GFC, it's become quite quiet. And that, frankly, has got a lot to do with what's going on with regulation. This is the unintended consequence of regulation, the fact that balance sheets are being constrained, risk capital is being constrained. And for me, one of the biggest risks is that this derivative market, which has grown exponentially for a bit and driven our growth, allowed us to compound at massive rates, is frankly being muted. Leverage ratios, BIS ratios, you name it, these things are changing. And we might just go to, so what I think we need to do is to think about, is it really possible to extract 5% rates? I mean, if you look at page, the next one, 25, you'll see that rates have, in the last couple of hundred years, been pretty low. I've seen these things going back, whether it's that effective, all the way to 1600, whatever. Rates are not 5%, they're more like 1%, 2% if you're lucky. And remember, this massive rate that we have all lived through has been a Keynesian bubble. And that Keynesian bubble has been, if you like, deflated. It's been deflated not necessarily because people are behaving better, governments are behaving better. We are in fiat money after all. But what has happened, we've learned how to, not just, in today's world, we're not just printing money, because again, we're not adding money. We're not just printing money, we're now adding money through QE, and it's a very different game. If you add money through QE that is non-inflationary, because you've got two sides of the balance sheet, but it goes on.
Well, Michael, thank you. And I think one of the keys and challenges we see is the enormous responsibility you have in managing money for those that need to achieve a rate of return. And in reality, very few people achieve those rates of return, I think, as Michael has pointed out, for a long period of time. Mitch, as you step back and think about some of these issues, I'd maybe like to change it a little. When you're hiring a person to join you at Canyon, what background are you looking for? What skill sets are you looking for in those individuals? You know, I've always had this view that if you really do your homework, you should not be that much surprised by the future. You might be surprised by the timing of when it occurs. And if you have enough staying power, you can live through that. But what is the type of individual you're looking for and have working on your team at Canyon, whether it be here or London, et cetera?
Well, the interesting thing about risk and return in today's world and the kind of skills that an individual would require to assess risk and return really consists of two things. One, I think you have to understand the language of business, which is accounting. And without it, I think the financial analysis is impossible. But the interesting thing about accounting is that when you look at what it is as a structure, a framework, it's a stock flow system, right? You know, balance sheet represents the integration of assets and liabilities, and the flows, the accruals and the cash, that's the derivative, right? So it's a stock flow system like there are stock flow systems in the physical world, the biological world, and in the social systems that make up our society. So when you reframe accounting, as we try to do at Canyon, you can understand how balance sheets go through dynamic change. And, you know, you've said before, capital structure matters, but when you think about it from a balance sheet perspective, the left side of the balance sheet affects the right side of the balance sheet, and the right side of the balance sheet affects the left, and they go through dynamic changes. So if somebody has the capability to look at accounting as more than a static system, but as a dynamic system, they'll understand when a company needs to take on more leverage, when it needs to take on less leverage, what kind of security can be designed for that company, where you put an investment banking, corporate finance overlay on value investing, and you say, look, I own your unsecured debt, but I could also help you with your bank debt. I could take out your banks that are pressuring you to sell assets. I could design a very expensive piece of paper, but you could take it out in a couple of years. It'll give you the time to sell whatever assets you have to sell in a more orderly fashion. And that kind of resiliency that you inject into the company not only gives a benefit to what you may already own in terms of an unsecured bond, but it provides a new investment that you've designed and solves a problem for the company and provides an opportunity for your investors. So if you can get an analyst to come to your firm that understands what value investing is, understands the fundamentals of accounting, and yet brings that other disciplinary flexibility, neuroplasticity, whether it's investment banking, corporate finance, understands that the world's complex, that accounting, when you reframe it, is a dynamic system that allows you to understand how balance sheets go through major changes. And by the way, in today's world, that's not changing. Balance sheets at the micro level are going to reflect the major changes taking place at the macro level, and they're going to go through step function-like changes. And you know that when there are step function changes in a business or a capital structure, it takes a while for the capital markets, for investors, to catch up. And that's where often you have the gaps and cracks that you can fill.
Thanks, Mitch. And I think one of the things that we often don't think about is social issues. And I know the very first speech I gave on Wall Street almost 50 years ago was the best investor was a social scientist. So when I think of your theories, Kyle, I think of 1980, Venezuela was rated AAA but had 30% unemployment. There is no AAA with 30% unemployment because there's potentially other things that are going to occur. And I think of your analysis on China today, what I really think about is the wealth of the individual Chinese, the middle class, upper middle, more millionaires and billionaires in the United States. And if they have 25 billion in deposits, if they just wanted to move 20% of them into another currency, one way or another, that's a movement of $5 trillion. And I think we sometimes underestimate human nature. And that's one of the reasons why Shakespeare is so popular today. He wrote about human nature, envy, love, etc. And we have to assume those emotions exist. So, Mark, let's go to you. What are you looking for in your firm? You obviously take advantage of tremendous opportunities, and by being one of the largest mezzanine investors, you've been able to generate equity rates of return in many cases and get safety in debt. What is the type of person that you're looking for your firm?
It was interesting. I was at a talk a couple years ago that Elon Musk gave, and he talked about the fascination at finding the most brilliant person you could find, and we certainly look for intellect at Crescent. But what he's found in his companies is that was often a bad hire because he really needed to find people who could work within a team. And we put a high priority on folks who can work within a team setting. If I were to look at any one thing we've been able to do at Crescent well over the last 25 years consistently, that would be building and maintaining relationships. And you have to be a good team player to do that. So we look to see, if I were to look at any one quality, it's how well a professional fits within the fabric of our firm and would fit within the team. We get, dozens, extraordinary number of resumes from folks who, have the skill set you can see on paper. And I will say, though, my partner, Jean-Marc, being a Harvard guy, get a little bit of an extra step in the mezzanine business if you came out of Harvard. But we have hired some folks from other institutions as well. So that's probably what we look for, fitting in well within our team.
Kyle, contrast a little bit your responsibilities and the team at sitting on the board and the committee of one of the largest endowments and the team that you've assembled managing the assets you have.
When you look at things from an endowment model, and you look at it when you have a very large endowment, back to your question to Michael about earning 5%. I think in the next 10 years that's going to be really tough, given where what is it, $9 trillion of sovereign debt at zero or below zero. The traditional endowment model has got to be questioned, and I think again the strengths of our team for the last decade have been thinking about things in a commonsensical way and trying to come up with solutions and timing for those solutions. And now, if you kind of were to merge those two thoughts, which is it's a big leap, but starting to talk about this idea of not being able to achieve 475 real or 5 real or whatever the number is that these endowments have to pay to their respective institutions is a really, really tough question, and it's something that we as an endowment board have endeavored to do for the last few years, but only in the last few years, which is somewhat shocking and not an indictment of us or our endowment board, but I think it's everywhere. It's just now starting. And whether you're endowments or pensions, you're just starting to believe this might possibly be a reality. And I think, our team at Heyman has been fortunate enough to question some of the dogmatic views of others over time. So, that's something that we look for in our people.
Well, one of the things we're looking for in this panel is not only common sense, but uncommon investors to achieve incremental rate of return. Michael, what thoughts do you want to leave us with today?
Well, it goes back to the fact that the world is incredibly complex, the world is incredibly volatile, and to do that you need to have imagination. To get through this world, it's one thing to be smart, but it's another thing to have imagination and to think about where you need to go and have the flexibility to go there.
Mitch, any last thoughts?
I think structurally, if you keep in mind from a common sense standpoint that structure determines behavior and behavior determines structure, you will recognize that when you're trying to understand where to invest in capital markets, that unless you understand institutions and how they behave, you're going to miss something. And whether those institutions are sovereigns, countries, or they're banks, or they're corporations, to simply do a discounted cash flow analysis or even basic accounting is not enough. You have to understand that human beings are social animals. They get a lot of leverage by forming organizations and institutions, but those incentives and decision rules in those institutions are going to intermediate their behavior and what shows up in the capital markets. And that requires you to understand the rules of the road, and increasingly so because the government is playing an increasing policy role. As you pointed out, many sectors of our economy are very subject to becoming utilities as we go through time.
And that is why we moved the Milken Center for Financial Markets
To Washington.
to Washington and bought the building across the street from the Treasury.
There you
Yes.
go.
Sarah?
All right, I'll end where I started, which is active management involves price discovery. And when you buy a passive benchmark, you get none of that. You don't get anyone's brain power. Example would be the great unemotional nature it takes to discover a stock like a Volkswagen last September. You all read about Dieselgate. 500,000 cars effective in the US, 11 million vehicles globally, but that company owns a couple of remarkable brands, Porsche and Audi. They own some great commercial vehicle companies like MAN. You can take the value of all that and recognize that the market had been, through passive selling of that stock, it was a constituent, ironically, in environmental, social, governance indices. It was an exemplary company, and then purged from those through tremendous, you could hear the hooves of the runs for the exits. That was a great time to go at this unemotionally. That's why you pay active management and to find that undervaluation.
Thank you, Sarah. And I think the other message the panel has given is that one we've long understood, and that is culture beats strategy all the time. And each of these organizations have built amazing cultures, which allows them to become uncommon investors. So thank you very much for joining us today. Thank you.